Hi all, thank you for joining us today for our discussion on streamlining your export pipeline to the UK and EU, perspectives from trade experts. We'll be covering a variety of topics ranging from remaining compliant with foreign regulation to strategies for finding local business partners and a whole host of things in between. There'll be 15 minutes at the end for Q&A, so make sure to submit your questions via the Q&A function throughout the discussion. To do that, click on Q&A on the right-hand side of your screen and type where it says ask a question. I'm joined by our wonderful panelists, who I'd like to thank for taking the time out of their busy schedules. If you could please introduce yourselves, starting with Emeka and then Charles.
All right, good morning, everybody, and thanks for joining us in this wonderful webinar. My name is Emeka Mordi. I am the country manager here at Verto, your cross-border payments company for Africa. Prior to this, I spent some time at Access Bank here in Nigeria, working on the digital lending platform for in the retail banking side of the business. So we were delivering loans to individuals and SMEs. And prior to that, I was a COO at Carbon. Thanks for having me.
Okay.
Great, and Charles?
Okay, thank you very much. So my name is Charles Anyanwu. I am the CEO of a lending business here in Nigeria called Bostocke Investments. Prior to that, I was with the Lagos State Employment Trust Fund, supporting SMEs across the state. Lastly, as the director for strategy, funding, stakeholder management. Previously, as the head of small enterprises. So I'm happy to be here.
Great, thanks. And Akinbo, I see you're in a car right now. Do you think you could give a little introduction for our audience? I'm not sure you can hear us. Alrighty. In that case, I hope that provides a clearer picture for our attendees. So without further ado, we'll jump right in. And once Akinbo's mic and tech is up and running, then he can introduce himself as well. Exporting to developed markets in Europe and Asia from Nigeria offers tremendous opportunities for businesses to expand their reach and tap into a new client base. However, the process is not without its challenges. Exporters encounter various hurdles, including the need to find reliable local business partners, navigate complex regulatory frameworks, and establish a cost-efficient payment infrastructure. These ever-present requirements have only been made more tricky with the current macroeconomic environment. Trade policy uncertainties and geopolitical tensions can disrupt established trade relationships and introduce unpredictability into one's expansion plans. Changes in import regulations, tariffs, or trade agreements can significantly impact market access and alter the competitive dynamics, making it only more essential to stay informed and adaptable to these evolving situations. Our panelists are here today to share some of their learnings after decades of operating in the world of exports and trade, in order that you come away with some actionable insights for your own business. So to kick things off, Charles, as someone who's worked closely with exporters in Nigeria, could you provide us with a summary profile of Nigeria's current exports? Perhaps what are the types of products being exported at the moment, and are there any trends you've noticed perhaps in terms of the breakdown between finished goods and raw materials?
Okay. Thank you very much. So yeah, it's been a very tough market. It has been for a while. I mean, there are infrastructural and other factors of production that have led to that. But just looking at the structure of the Nigerian international trade, is one that predominantly we've been in the deficit. So what do I mean? Essentially, we are looking at the aggregate sell versus aggregate buying patterns in Nigeria, and the effect of that on our currency. And so when we have generally a net aggregate surplus is when we are selling the value of everything we've sold is higher than everything that we've bought. And the reverse means that we are in a trade deficit. So essentially, over the years, Nigeria has been in a trade deficit, meaning that we're essentially buying more. The value of everything we have bought is more than what we've sold. And there are reasons for this. And so what is it essentially that we are buying? What are these goods that we are buying? We'll look at which being an in order ascendancy in terms of the actual value that you derive from selling these goods. So at the very basis, raw materials. And these essentially tend to be natural goods. Intermediate goods comes in after that, which is essentially some level of processing of these natural goods as inputs towards finished goods. And then, of course, right above that, we have consumer goods, and consumer goods essentially are what the average person buys for consumption. And on the top of the pyramid is capital goods, and capital goods tend to be man-made goods. And these goods are goods that companies require to provide their services. So if we dimension this for classification of goods, you will find that capital goods essentially require significant manpower, so human capital development. That's where things like education, etc., and all of these things, training and whatnot, comes in. And so it's priced higher than raw materials, which are natural, you'll find in the ground. And if we look at how Nigeria is currently operating vis-a-vis this for goods, you'll find that, for instance, from an export perspective, which is what we are selling out, over 77% of what we sell are raw materials in Nigeria. So that means that we are playing predominantly at the lower spectrum of real, intrinsic value in terms of what we're going to get back. And this essentially trading raw materials has to do majorly with crude oil and other oil related goods. So that's essentially where we're playing. And for intermediate goods, we have somewhere around 5%. Consumer goods, we're somewhere around 13%. And for capital goods export, we're only right about 3%. So 3%, where we are to derive significant value, we only play at 3%. But when we look at imports, it's the reverse. So in terms of imports, we are only importing 7% thereabouts of raw materials. The story this tells is that from a productivity perspective, we are not manufacturing as much. And so we are not importing raw materials. So we are spending less in the areas that are supposed to be cheaper. So we buy expensive, but sell cheap. Intermediate goods, somewhere around 26%, consumer goods. Now, consumer goods and capital goods, like I said, are the upper bracket. And we are spending 34% of our import is in consumer goods and 31%. So combined, we have over 65% of the total imports at the highest level from a value perspective. And so when we look at these two divergent dynamics, you find that we are most likely to continue in a trade deficit. And this is the trend and has been the trend for a very long time. Now, when you look at this raw material, which is essentially crude oil, and you look at where the world is going with fossil fuels and and trying to get a cleaner environment, etc., it means that there's a lot less demand for what is predominantly our major export and revenue generator. So we are not necessarily playing this market efficiently. And if we were to delve slightly deeper into who are, the countries, the continents that we are dealing with in terms of this, trade, you'll find that major exports that we have currently, if I look at the National Bureau of Statistics for Q4 last year, major export destinations: Spain, Netherlands, India, France, and Indonesia. There's a little bit of a tweak to this, and of course, you will find that since 2020, the dynamic has changed. Whereas we used to have a lot more export to the likes of the US and China prior, it's changing. The US, because they're moving away from fossil fuels, they're also moving towards self-sufficiency. China, because with COVID, there's been a lot of restrictions on goods coming in and also goods going out. But again, when we look at imports, we'll find that we're importing more. 25% of everything that we imported in Q4 last year was from China. And then Belgium, slight second, India, Netherlands, and then the United States. So we find that a lot of what we are importing currently is coming in from Asia, and then Europe is second. And so the dynamics around that, importing from Asia and then exporting mostly to Europe. It tells the story about why. And when you just oppose that with the area where we are playing, where we're essentially playing in the lower market in terms of our ability to generate income, because we're not strong in the capital goods area where we have significant value, then it doesn't bode well for us as a country in terms of the economic development that is required to position Nigeria, into prosperity, as well as to create an environment where you have increased GDP, per capita income increases, and then the Gini coefficient moves more towards equality, because there's a lot more, because we do have the human capital in terms of the numbers. But one of the things we need to do is improve the quality of what that human capital is able to provide. And I think we can always go back to the stories of how India was able to do this and how China was able to do this and transition their economies into global players. Maybe these numbers, tell a story that we need to consider.
Oscar, we can't hear you. We still can't hear you, Oscar. We still can't hear you. While Oscar is sorting out his microphone issues, thankfully we have some idea of what the series of questions are going to be in terms of the topics. And the next topic that we're discussing is around what the general attitude is of European businesses towards Nigerian products. And I think Charles laid a very, very good foundation for this discussion because looking at the value chain and the different categories of the actual products that we're able to deliver within country and then start shipping out, it already creates that picture of how our value is seen by the rest of the world. And of course, speaking in the context of where we are exporting to as well, also sets the stage for this. As we've seen from the beginning of this conversation, right, we are exporting a lot of raw materials. Whether we like it or not, that is really at the bottom of the food chain when it comes to actual development and creating value in that hierarchy, with capital goods being at the very top and raw materials being at the very bottom. So I think the first thing is just to understand that in the context of not only Nigeria, but I think the continent at large, we are seen as a provider of raw materials for finished goods. So you have essentially this mindset to start with, but also from a very operational and financial standpoint, a market that is geared towards receiving your raw materials. What does that mean? It means that, okay, there's storage, there's transportation, there's ports to actually take in these raw materials without really any care for any of the mid-level stages that go into production for the capital goods and the consumer goods that are really taken by the society at large in Europe and the States. And that means that when they're looking at the actual raw materials that we're delivering or exporting, it's really the very basic level of what is the quality. So you're exporting oil, you're exporting cocoa, you're exporting whatever raw material is. It's interesting that you have a lot of input into the development of those raw materials. So you will have Europe and the rest of the world helping us with seedlings, helping us with farming tech, helping us with know-how so that we can get the best out of our limited acreage in terms of when you talk about farmland for the development of this raw materials. And then it's just a question of here in country, in Nigeria, for example, those gateways and processes and the quality control and checks and balances they try to put in place so that when the goods arrive in the West, then they're able to grade them very easily, and then they enter their own production processes out there. So it's interesting that you will see a lot of producers in Nigeria that don't actually produce for the Nigerian market. They will tell you, because they are going to, if they are exporting, then they are receiving forex, which is in great demand, even though it will not be as much as the forex they will be receiving if they're selling capital goods. At least they get some kind of protection against your currency devaluation, against your inflationary pressures, and so on and so forth. Of the naira. So I think as it stands now, we are seen largely as a supplier of raw materials. There are very few areas or very few places you will walk into where you will find finished products that start at the beginning of the supply chain in Nigeria and also end as finished products in Nigeria. We are seeing a little bit of an increase in this today, but it's generally with smaller items. You have some snacks, you have some food items, you have some you have some items that do not require a lot of heavy production because, again, from a capacity standpoint, we haven't necessarily built out that production and manufacturing capacity in country to be able to export to the quality and the standards that are demanded in Europe and the rest of the world. So if you take into consideration that across Europe, there are standards for all the EU members. And then even if you're not in the EU, for you to be able to sell into the EU or to EU countries, there's certain standards that you have to meet when it comes to the manufacture of products. So as it is right now, specifically in Nigeria, we are not adhering to a lot of those standards that have been set up. If you go back to what Charles said, a lot of what we are importing is actually coming from China, not only the finished products, but also technology and infrastructure. So when you start looking at that, you see even that if we start to manufacture, we're manufacturing to potentially different standards. When we talk about the States, one of the reasons that it might sound very academic is that we just don't use the same measurements. So when we're talking about factories and equipment and so on that needs to be brought over, you have to worry about, is it going to actually fit the standards of what we actually have in Nigeria, which traditionally has been built around the European standards. So I think we are seen as a supplier of the lower end of these scales, as Charles expressed to us. So it's raw materials. They are able to, or the markets out there are able to control the quality of those raw materials to a certain level by being involved in the actual production process of those raw materials. But as we've seen, even with countries like Ghana and so on, we will struggle because of this structure that is already set up, which means that the West is not built around receiving finished goods from the continent. So I think that is the view right now, that in general, it is the raw materials that they are looking to receive from us. And what I think we will have to figure out from a manufacturing standpoint is, how do we keep pushing manufacturing and production in country so that we can serve not just that bottom of the development section, but higher up till we get to the point where we're actually supplying capital goods, whether it means that we have to face other markets like other African markets or so. We have to actually look at that to be able to actually increase value within the country. Thank you.
Great. Thanks, Emeka. I don't know if you can hear me now.
Yes, we can.
Perfect. Sorry about that. So we've received a few questions in the Q&A, but I'm quite conscious of time, so we'll answer the questions a bit later. In the meantime, yeah, if you do have any questions, make sure to submit them through the Q&A function on the right-hand side of the screen. So now that we've established a clearer picture of the macroeconomic context and the challenges of exporting from Nigeria specifically, Charles, could you perhaps now that we've talked about the supply side, could you perhaps address the demand side? In terms of perhaps the largest risks that exporters face when exporting to Europe and to Asia?
Okay. Let me start with Asia. I think one of the things that we see again, since we already established that a lot of what we do is export raw materials, which requires little human capital development. what we're seeing recently is that, of course, Asia has always built its growth around some level of protectionism. And so there's always the desire, preference to trade with local companies, Chinese-owned companies in particular. And of course, China dominates that market in terms of the Asian market. And so you find that there is trade, but you'll find a lot of the Chinese companies coming in locally to set up, because of course the barriers to set up in Nigeria are less stringent than you have in Asia. So they can come here, they set up, pay locally for the raw materials, because essentially that's what we are selling, and then they export themselves, leaving Nigerians out of that equation. And in most cases, they use that to, I wouldn't say boycott, but I'd much rather say they use that to increase the value that they derive from trading with Nigeria and with Africa. So the certain bilateral arrangements that they have with the governments, supporting with debts in certain areas, and in return, they almost sort of get a free pass. Another challenge that you saw, so this way, you'll find that there are fewer Nigerian local companies that are able to trade volumes with, even though there is, on paper, there's significant amount of movement from Nigeria to Asia. But you will find that those controlling that movement are not necessarily local Nigerians. It's the same also you have with Indians. So you have a lot more of the Indians coming here, because they have cheaper funds, right? So, and in China, you have a lot of government support for things like that. And so there's movement, but it's not controlled by local companies. Now, another challenge that you have with Asia, I would say also, is around traceability, in terms of being able to ascertain who a credible buyer is. Unlike Europe, where things are a lot more centralized, in Asia it's a lot more fragmented. So there is a high potential that if you are not paying attention, you can lose value. And so that's also one of the challenges that you face in the Asian market. So the due diligence that is required is a lot more significant, just so that you protect your value. There's also issues around currency and conversion, because unlike Europe, where you will find that a lot is happening with EU through the euro, also in USD because of certain bilateral agreements. In Asia, they seem to be moving away from that. And what you'll find is that you can have, things essentially traded on their own exchange, using local pricing, and then converting from local pricing to US dollar. Now, because there are issues around, or conversations around, currency manipulation, etc., you can very quickly lose value if your treasury function is not, your treasury function is not up to speed. Because what then happens is, by the time you have to first convert from local currency to dollar, and then back to the Nigerian currency, if you need that right, then you're losing money in that area. And so that then requires the average Nigerian local business to ensure that they're not just working to ensure that the quality is good enough for the market, but also the pricing regime around all of that then becomes an additional burden to make sure that you have the capabilities in-house to be able to determine when you're losing money from FX currency movements, etc. And so, of course, there are some solutions that are coming in now with multi-currency accounting, etc. But these are some of the issues. Working with Asia, look at the trade terms. When we go back to the issues around traceability and being able to determine who a good, reliable, legitimate is in countries, trade terms also then matter. So, as opposed to where you can probably get in with CIF, which is with insurance and freight, you may be looking at potentially working with free on board with Asia, because when you look at the financial institutions that tend to fund, there's a lot more confidence around the EU than the Asian market, essentially, again, because it's quite fragmented. And so when you then begin to look at financial instruments to support your trading, the trade terms then become something that you really need to focus on, so that the turnaround time and the value that you also, because a lot of this trade happens on credit. And so if you are doing a CIF as opposed to an FOB, then you're going to have challenges around your cost, your actual cost, because the time, they always say time is money. So the time it takes for you to export and the turnaround time for you to be able to get paid, the value lost in payments, etc. So these are some of the things that you also need to take into consideration when dealing with either Europe or Asia. And also the market conditions right now. I mean, we are not operating in isolation, right? So I think COVID 2020 has really changed the dynamic of the risk assessment that we have to do now before we make a commitment towards trade. So currently, if you look at what's, because of course the likes of China, India were hardly hit by COVID, of course, as was Spain at the time. We have had a lot of challenges with shutting down of production, and of course that has led to a different dynamic in terms of the market conditions now. And if we dig deeper slightly, you'll find that labor costs have also gone up, in these countries, and which means that these products become a lot more expensive, and because there's a general decline in terms of negative growth due to supply chain challenges posed by COVID and all whatnot. You'll find that there's a lot of strain now, and people are not able to move as many products as they were prior, and so these countries are not necessarily able to churn out as much product as they used to. So for the typical or the local exporter, you'll find that volumes have dropped significantly from what they used to be, which means that there's already value erosion for the local players. So I think that when we dimension of course, when you talk about Europe, then there's an additional risk, and I think that Emeka alluded to that in terms of the quality standards that are applicable across Europe and the US, and then of course Asia on the other hand.
Charles,
quality standards. Yes, please.
Sorry, Charles. I'm quite conscious of time, and I do want to get everyone a chance to speak and share their insights. So I see that Akinbo has just joined. I think you raised a good point, Charles, around having the appropriate payment infrastructure to make sure you can support your operations. So in that case, Akinbo, there are several elements that modern treasury functions need to have, like automation and multi-currency accounts, and also having local accounts in target markets. What are 3 things you think exporters need to keep in mind when they're building their payments infrastructure?
Hi, am I coming across?
Yeah, it's working perfectly on this side.
All right. So building out the payments infrastructure, I think Charles covered one of those quite clearly. It's having funds that, the traceability of funds, making sure that the payments that you're sending, especially when you're dealing with countries like ours, which are developing countries, a lot of recipients want to know that, they're not going to get recalls from their banks for funds transfers, or they're not going to have payment issues, transfer sent out today gets to them, within 24 to 48 hours. So how the payments are sent is really important. One thing I wanted to touch on, which is quite interesting, is the APIs. So for us, for instance, a lot of our billing and invoices are dynamically generated from the currency exchange rates. And recently, in the past few months, Verto started to allow API calls. And we actually use this quite frequently. We get API calling dollars, euros. Those are our 3 predominant currencies. And we get API calls put out on those every hour. So we have very up-to-date exchange rates, and those are then fed straight into our pricing models. So having this sort of data, real-time data, to support our operations is quite useful. It means we're competitive in terms of pricing because our pricing is current and it's not estimated, and this puts us, ahead of some of our competitors. The other thing in terms of treasury and perhaps hedging, I think would be the other side, which is more difficult for most companies. But we're talking about exports. So exporting is essentially the best hedge to deal with the price volatility of the naira in our case, since we're starting from Nigeria. That's it for now.
Great, thanks. And so you talked about how automating your treasury through API calls to get up-to-date and fresh data on exchange rates has helped you cut costs and make your treasury function more efficient. Emeka, another trend that's that's gained speed recently is having local accounts in the countries to which you're exporting to make it easier for your business partners to pay you directly. So how important of a trend do you think this is, and how crucial how much time should exporters be dedicating to setting up those sorts of tools?
I think it has reached the point where it is key. If you are trying to export any kind of product, whether it's a raw material or it's somewhere in the middle, your payments and the speed and traceability with which you receive your payments is key. For all of us sitting here, and for all our wonderful listeners as well, I'm sure the phrase "time is money" is something that everybody recognizes and actually appreciates. So the ease with which you can send payments and, very importantly, receive payments for your products and services is key. I think it is something that is going to continue, and it will get to the point where this is no longer a trend, but as a continent or as a country that has such an important role to play, not only within Africa, but in terms of the world when it comes to supplying raw materials and products across the globe. Any exporter who is only dealing in a local Naira account will be at a disadvantage. Buyers want to be able to stay fixed in their local currencies, whether that is the yuan, whether that is the euro, whether that is the pound or dollar. And they expect you to have the infrastructure to collect payments in those currencies as well. So I think we're moving very quickly away from it being a trend to being a standard necessity for you to be able to do business. And I think to also just buttress what Akinbo said, right? When you talk about exporting, the speed that you're able to move to fight against the inflationary and devaluation pressures now becomes really, really key. If there's any part of your process, whether it is treasury or payments, or your contracting or whatever that is lacking, then it has the potential to affect your business significantly, because a 1 Naira movement in a pricing regime can mean losses or significant losses depending on what you're selling. So I think these things that we talk about right now as trends are getting to the point where they are very significant foundational pieces for anybody who's looking to get into the export business.
Great, thanks. So we've talked about having the appropriate payment infrastructure, and one of the questions that's come in now from our audience is from Austin, and I think this one's best suited towards Akinbo. Hi, I'm curious about exportation from Nigeria to the UK. Can you give me a rundown of the process? Say I want to export maize from Nigeria and I have a contract to supply to a partner in the UK. What do I need to know, especially in terms of shipping and relative cost components? So Akinbo, perhaps if you could talk about the logistics around exportation and what are the crucial elements to consider when setting up your logistical operations, if he's still with us.
It looks like we've lost him. Charles, do you want to take a stab at this one?
Because yeah, I was thinking otherwise, Charles.
You're the last person.
Okay, thank you. So if I got your question right, is he has a contract
to supply
a UK business, and he is looking to supply maize. Okay.
Yeah.
So first question is, I think for me, the way I would look at it is so you have to first of all look at the list from the EU or the UK, find out if that product essentially is one of the products that they will that they accept. So if it's on the ban list or not. Now, in terms of the species that because maize is not just maize, so you also have to do some level of testing to ascertain if the particular species that you have is acceptable in that market. So you don't waste all of that effort sending something that is rejected, because this is often always the case when this export to Europe, is that there's a high rate of rejection of those products. So I think once you have the fundamentals right, which is that I have a product that is acceptable, to that market, and then you then have to do some due diligence on who. I think it's easier, like I said earlier on, it's easier to to verify who the buyer is and make sure that you're dealing with the right kind of company. And then the next step is you have to draw up a contract that will meet you somewhere in the middle, something that favors you in terms of how payments will be made, what currencies you're trading with, etc. I know there are also standards around this, so you just have to do some additional research on that. But once you have first a product to a legitimate buyer, and you have a contract, and then the next step is financing that business. Because I mean, I don't know what your pocket is, but the next step I would consider is how you're going to finance that business vis-a-vis what the projected margins are. And so if we look at the margins are very thin, you have to then be careful. If you're able to secure external funding, maybe from a financial institution or the likes of and family, you have to then do your own math on the numbers. And then once you have your numbers right, then you can then proceed. One of the things that I would also recommend that you do is always try to shadow somebody. Don't just go in on your own. This is one thing that I always say, because there will always be challenges along the way. You want somebody who will provide you with some level of hand-holding, especially when you're just starting out. I think once you have all of these things in place, don't be eager to start too big. I would say start small and manage that growth. Because often always what happens is people want to get the big contracts very quickly. And if you have got I don't like to use the word water, I don't know water type, but if you haven't got your process, in place in terms of that operational experience, then you don't want to be committing too much resources into this first project. So start small, do the needful, do the homework, find somebody to shadow, you can shadow and then proceed.
Great, thanks, Charles. Very clear overview. We've got another question coming in now. So we're in the Q&A now. So if you have any questions that you want to send over, make sure to click on the Q&A function on the right-hand side of your screen and just type in your questions there, and I'll read them out to our panelists. So yeah, one coming in, I think Emeka would be the best suited for this. Hi, my biggest problem is around getting dollars. How can Verto help with that?
All right. So as you will find out now, the business that we are in is to help exporters and also importers with liquidity. So what we do is we work with liquidity partners who are generally other financial institutions, to make sure that the amounts that are required by our businesses are always available to them. So when you're a Verto client and we get some kind of understanding of the cadence of your requirements for any of the exotic currencies, your G10 currencies, so euros, pounds, dollars, so on, and even currencies across Africa, then we make sure that those currencies are available to you when you need them. Obviously, the secret juice of how the availability comes about, I will not be able to tell you right here, but we do make sure that liquidity is available. I think the one thing I would like to add to that is sort of putting together everything that Charles and Akinbo actually said, because when you're thinking about your dollar availability or even requirement, right, you have to take into consideration what your pricing of your products is going to be. What are all the costs that you actually have in your business that you have to put in, so that when you're producing and you're thinking of selling or you're thinking of paying for something, you are actually factoring in all those costs before you make your purchases. Because whether it's you're purchasing goods and services, or you're purchasing equipment, or you actually just want to hold forex for a later date to purchase something, there's a cost associated to it. So Verto helps our clients by having a strong treasury product and treasury platform. We allow businesses, or we help businesses see the entire treasury landscape that they're dealing with. And this means that you can see all your businesses across different regions, across different currencies, and have one holistic view of your treasury, no matter what currency that you happen to be holding. And we provide liquidity. So regardless of whatever amounts you're looking for, it will always be ready when you need it. Like Charles said, again, you want to be able to make a payment to a provider or a supplier, and that payment is reaching them in 1 or 2 days. You don't want to have to be telling stories about when they're going to get a credit or not.
Great. Yeah, I think that covers the question quite well. We have another question coming in from Henrik, who I think is on the other end of the table. What are the obstacles to trade if we turn the table? Imagine an EU company wanting to sell its products to Nigeria. What are the key things that European companies should be focusing on when they're trying to expand to the Nigerian market? Charles?
Okay, thank you very much. So yeah, like you said, it's the reverse. I think this is first, again, we will always start with, is this a product that is on the it's on the ban list or not? And then you also want to do some work around the credibility of the buyer, and of course, and then you need to. So of course, there's all of that due diligence around what is the long term. I would say, what's the long term viability of what it is that you're selling, and where exactly are you playing? Is this there's very little raw materials coming in, so is this consumer good or is this capital good? And what's the long term viability of that in terms of is there any market changes, any regulatory concerns that may affect that? That's one of the things that you have to be wary of, because there's a lot of policy flip-flopping happening across Africa. So that's something you also need to consider. If you are able to determine that there is actually a long-term viability for that product, then we begin to talk about credible buyers and the ability to pay for that service. And again, I think that because there's a lot happening right now between the UK and Nigeria in terms of trade policies are looking to be a lot more favorable than they were ab initio. I think, that's a fallout of the UK and EU and all of those changes that have happened, and looking at other areas, particularly Nigeria, essentially, which is a huge market. It's 430 something billion GDP. So I think if you have and the same thing I said about Asia, you need to have somebody handholding you as well, because the markets here can be quite they can be quite volatile. And again, when we talk about payments, sources of funding, etc., you don't want any of these issues. So we want to be working with credible businesses, or even in terms of traceability of the funds that they're using to pay, etc. You don't want to get into any challenges with any of those. So I think that if you have those things in place, then you're probably much better off, or you're setting yourself up for for success in the Nigerian market.
Yeah, I will just quickly add, if you're looking to do business in Nigeria, I think one of the good routes to go is to connect with all the different chambers of commerce. I think that is always a good starting point. When you have organizations like Charles was working with at LSETF as well, that is helping to aggregate and support a lot of businesses. They create these hurdles that when businesses are able to jump over them, they have a lot of credibility. They have a lot more strength as well to also deal with foreign businesses that will have demand for their products.
Great. Great. We've unfortunately run out of time for questions. So nonetheless, if you're hungry for more insights into streamlining your export pipeline, or how to set up an efficient payment infrastructure to support your international expansion, I'd encourage you to go check out our website, where we regularly post articles on topics ranging from building an online e-commerce presence to managing dollar shortages, as we discussed. You can also take a look at our recently launched podcast, Forex in 5, which has received great positive feedback that delves into specific trends in African FX, like the impact of South Africa being added to the FATF grey list, or the effects of the new Nigerian government's policies on exchange rates. Make sure to fill in our feedback form once the event is over as well, to help us provide the best quality content for you. You can also find Verto's product handbook by clicking on handouts on the right-hand side of your screen, if you'd like our help with optimizing your cross-border payments. I'd like to thank our amazing panelists for joining us today, as well as our great attendees. It was a pleasure to have you all with us today. Thank you all for attending, and we hope you enjoyed the event.
Thank you, Oscar. Thank you, Charles. And thank you to the lovely audience as well, even though I can't see everybody.
Yes, thank you, Oscar. Thank you, Emeka. Thank you, everybody.